We think this is going to turn around, even after all of the pressure recently on Bitcoin and the soaring of the gold price. So we expect Bitcoin to gold to turn around, and we expect it to happen both ways. The Bitcoin price going up and the gold price going down.
Cathie Wood begins by addressing one of the dominant fears circulating through global financial markets today: the possibility that the world is heading toward a repeat of the 1970s inflationary crisis. Many strategists, investors, and economists are closely watching a range of macro indicators that they believe signal rising inflation risks, fiscal instability, and the potential breakdown of traditional financial systems. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
So this, of course, is fiscal policy, S&P relative to gold. There are some strategists out there that I respect highly who keep a close eye on this metric out of fear that we're going to end up in a 70s-style inflationary bust. We don't think we are. We think gold's ahead of it itself, and that the war here has caused some perturbations in the S&P, and so we expect this one to turn back around. And we're encouraged by the next one. Until recently, S&P relative to oil was near an all-time high. And you can see where we are at today's oil price. So it's come down a bit, but still near its high. Doesn't look anything like it did during the 70s. Here is Bitcoin to gold. Of course, we're very focused on the new global monetary system, which we believe is Bitcoin. We think this is going to turn around, and are struck that we're higher than those last two big lows, even after all of the pressure recently on Bitcoin and the soaring of the gold price. So we expect Bitcoin to gold to turn around, and we expect it to happen both ways. The Bitcoin price going up and the gold price going down. This is the chart that I still noodle over. It's just, my goodness, metals to gold. Gold hitting all-time highs and moving up so rapidly certainly is a part of this story. But typically metals would have followed by now, and they haven't. Sure, some of them are up. Copper crossed $6, now it's back below. But we expect this to close maybe both ways, with interest rates coming down as more and more investors understand that we might be going into a negative inflation environment, and the metals to gold chart will turn up as the gold price comes down and metal prices participate in this budding, rolling recovery. So stay tuned on that one. The bond market has been very concerned about the deficit. The federal deficit, as the government issues more and more debt, the tendency is for prices to go down of Treasury bonds and interest rates to go up. It's been very interesting to see, since I think it was September of, I'm going to say 24, that's when the 10-year Treasury yield peaked at 5%, and when the deficit was the talk of the town in bond land. Well, what you can see here is the deficit is improving, and that's without the rolling recession really turning into much of a boom. When it does, we think it's going to close to that 3% mark, which Treasury Secretary Bessent is aiming to achieve by the end of 28. So we think the surprise is that they're going to do better than that. They'll probably be able to get it down closer to zero. Already we see progress. We're about to crack the 5% mark. And you can see how crazy it was during COVID. But you can also see in the early 80s, which is when I was very young in the business, 5% was where the bond market freaked out. And you can see what happened. It slowly moved up as really we were in the PC revolution. Took a while for software to kick in, but the growth rate of the economy accelerated, and that was a big way that we got down to that 3% mark. Okay, the next chart is the trade deficit. Now, in the 80s, the twin deficits were the federal deficit, so government, and the trade deficit. The thinking back then and the fear was if we're running a huge trade deficit, then that means that we're spewing dollars into the system, and the risk is that the dollar is going to go down. And we're beginning, and that's part of the narrative today, too. Many people believe that we're going to continue to run trade deficits, and this is a very bad thing because it will weaken the dollar. We do not agree with that at all. We think, just like in the early 80s, that the trade deficit, and we don't have it on this one, but anyway, the trade deficit was not the relevant variable. The trade deficit gave way to tax policy in terms of importance. And in the Reagan administration, cutting tax rates, using accelerated depreciation and other incentives to attract foreign direct investment to the United States got our economy revved up and increased the return on invested capital here in the United States relative to that in the rest of the world. And so our dollar soared.
Another major concern among investors has been the U.S. federal deficit. Conventional thinking suggests that rising government debt should push interest rates higher as markets demand compensation for increased borrowing. Larger deficits typically lead to falling bond prices and rising yields.
So you can see what happened in the early 80s. The dollar soared as the returns on invested capital in the United States moved up dramatically. And it soared to such a high level that emerging markets were in a great deal of pain because they had so much dollar-denominated debt that they needed to surface Treasury authorities and monetary authorities from around the world really came together in the Plaza and Louvre Accords and agreed that the dollar had hit too deflationary a level. It was going to cause deflation everywhere. And so you can see what happened after that. Now, it might have gone down too far after that, but if you take away that burst in the early 80s, you can see where we are today. We're not at the bottom of the range. Many people used last year's decline to say U.S. exceptionalism is dead, the dollar's in decline, and I think, as you can see, it has held at what technicians would call support. And I really think its next big move is to the upside. And that will help with our negative inflation story here in the United States. But the burden of proof is on us, of course. Interestingly, the purple line there is M2 growth on a year-over-year basis. It has slipped from 4.6% to 4.3% in the, I think that's a January reading. And the CPI, not as clear here, but the CPI also came in lower than expected. It was 0.2% month to month, so that's a 2.4% annualized rate, and it's a 2.4% year-over-year rate. Now, one of the questions we're asking is, okay, velocity helped us when money growth went negative. Velocity picked up dramatically, the rate at which money turns over. Velocity is flattening out, but if our estimate for the first quarter is right, it's probably not declining. And that's important because 4.3% year-over-year growth in money, if velocity were declining, would take some of the power out of that money growth. If velocity were down 1%, for example, on a year-over-year basis, then real GDP, given the 4.3% M2 increase, nominal GDP would be up only 3.3%, not leaving very much room for growth and inflation to coexist. And as you know, we think real growth is going to dominate and that inflation is going to fade away. This is the yield curve at the short end of the curve. So this is the 2-year Treasury yield minus the 3-month Treasury rate. And you can see that is in negative territory still, which means despite what you hear from the Fed and from observers of monetary policy, this means that the Fed is still erring on the side of hawkishness or tight monetary policy. And you can see on the next page the yield curve from a different angle, and I'm fascinated by this one. You can see that trend line down there. That's an important message, we think. But before we get there, you can see during past recessions, which are shaded here, that the yield curve steepened quite significantly. And for the past 30 years, got into the 200 to 300 basis point range. In other words, 10-year Treasury yield at least 200 to 300 basis points higher than the 2-year Treasury yield. So we found what happened after COVID very interesting, and during COVID, that the yield curve did not go back to that 200 to 300 basis point range. And we thought that meant something, we just didn't know what it meant. And so here we are, we're in another period of monetary easing, and we got into, I think we might have gotten up to 70 basis points positive. And now we've slipped back to 55% basis points. Why are we focused on this? It's because we did study the last technology revolution in the 50 years that ended in the late 20s, 1920s, that is. So that was railroad, telephone, electricity, internal combustion engine. And if you look back then, the yield curve was inverted more than half of the time, I think well more than half of the time, and the average inversion was 100 basis points, so 100 basis points negative. So stay tuned. Let's see what happens if we're in the same kind of environment.
Taken together, these indicators point toward a macro environment that may look very different from the inflationary fears dominating today's headlines. Equity-commodity relationships do not resemble the 1970s. The bond market is stabilizing despite deficit concerns. The dollar may be poised for renewed strength. Inflation data is moderating, and monetary dynamics suggest that productivity gains could offset price pressures.